In this video, I will show you how to earn guaranteed returns with Singapore savings bonds, including the latest December 2024 rates, and why this might be your best chance to lock in higher yields before potential rate cuts next year. Plus, I'll share a simple strategy to maximize your returns that most people overlook. Hey friends, welcome back to the channel. I am Iggy here, and I've been covering topics such as stocks, finance, CPF, and basically everything related to growing your wealth. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 800,000 reads. I've covered over 500 videos and over 250,000 watch hours as of September 2024. The December 2024 Singapore Savings Bonds, SSB, issuance comes with a first-year interest rate of 2.48% and a 10-year average return of 2.72%, following a step-up structure that reaches 2.97% by the 10th year. For a $10,000 investment, this translates to potential earnings of $2,720 over the full 10-year period. While SSB rates have generally trended downward since their 2022 peak, the December issuance offers a more attractive return compared to November's 2.56% average, making it a compelling option for investors seeking stability. These government-backed bonds stand out for their investor-friendly features, including penalty-free redemption and a low entry point of $500, with interest payments every 6 months. Conservative investors can take advantage of this balanced investment option when applications opened from November 1 to November 26, 2024, with bonds being issued on December 2, 2024. While these projected rates carry a 23% confidence level and may adjust before final announcement, they represent a solid opportunity in the current market environment. To put these rates in perspective, let's look at Singapore's latest inflation numbers. Singapore's inflation story in 2024 shows some interesting patterns that help us understand the value of current investment options. Core inflation, which leaves out changing housing and car costs, rose to 2.8% in September 2024, marking the second monthly increase after hitting 2.7% in August and 2.5% in July. This gradual uptick was mainly driven by rising retail goods prices, though food costs have slightly decreased to 2.6%. The overall inflation picture looks more moderate at 2% in September, down from 2.2% in August, largely due to falling private transport costs. Looking ahead, the Monetary Authority of Singapore projects a gradual cooling of inflation pressures, with core inflation expected to settle around 2% by the end of 2024. For the full year 2024, they forecast core inflation to average between 2.5% to 3%, before dropping further to 1.5% to 2.5% in 2025. This declining trend in inflation makes current investment options like Singapore savings bonds more attractive, as their returns remain relatively stable while inflation moderates. The bond step-up interest structure and government backing provide a reliable way to protect your money's value, especially during these times of economic adjustment. Let me walk you through how SSBs actually work. Singapore savings bonds offer a unique combination of safety and flexibility in today's investment landscape. Starting with a modest sum of 500 Singapore dollars, investors can build their portfolio up to 200,000 Singapore dollars, making these bonds accessible to a wide range of people. The step-up interest structure is particularly appealing. Your returns gradually increase the longer you hold the bond, with interest payments arriving reliably every 6 months. For example, if you invest 10,000 Singapore dollars in the December 2024 issuance, you'll start earning 2.48% in the first year, with rates climbing to 2.97% by the 10th year. What makes SSBs stand out from other investment options is their unmatched flexibility and government backing. Unlike traditional fixed deposits or corporate bonds, you can withdraw your money anytime without penalties, and your principal is guaranteed by the Singapore government's AAA credit rating. The bonds are also remarkably straightforward to manage. You can buy them through your local bank account or SRS funds, and the interest earned is tax-free. For conservative investors or those looking to diversify their portfolio with a low-risk component, SSBs provide a practical balance between accessibility, security, and reasonable returns. The application process is simple too. You can apply through your bank's internet banking platform during the monthly application window, which typically opens from the 1st to the 4th Tuesday of each month. The application process for Singapore savings bonds is designed to be user-friendly and accessible through Singapore's major banks DBS/POSB, OCBC, or UOB. Before you start, you'll need two essential things: an individual CDP, central depository, securities account with direct crediting service activated, and a bank account with any of these participating banks. For the December 2024 issuance, you can submit your application from November 1st at 6 p.m. until November 26th at 9 p.m. The bonds will be allotted on November 27th, and successful applicants will receive their bonds on December 2nd. The actual application can be done through several convenient channels: your bank's internet banking platform, mobile banking app, or even at ATMs. The service operates from 7 a.m. to 9 p.m., Monday through Saturday, excluding public holidays. Each application requires a small non-refundable fee of $2, and you must invest in multiples of $500, starting from a minimum of $500 up to $50,000 per application. If you're using internet banking, you'll need to navigate to the Singapore Government Securities or Investments section, select Singapore Savings Bonds, and follow the straightforward prompts to complete your application. Remember to have your CDP account number handy during the application process, and you can choose to pay using either cash or your Supplementary Retirement Scheme (SRS) funds. Building a bond ladder with Singapore Savings Bonds is a smart strategy that can help maximize your returns while managing interest rate risks. Instead of investing your entire sum at once, you can spread out your investment over several months. For instance, with 50,000 Singapore dollars, you could invest 10,000 Singapore dollar monthly over 5 months, which creates a staggered portfolio of bonds with different interest rates and maturity dates. This approach helps you average out your returns across different rate environments, protecting you from putting all your money into a single, potentially lower rate period. The beauty of this laddering strategy lies in its flexibility and regular income potential. As each bond reaches its maturity date, you have three choices: reinvest at the latest rates, use the money for expenses, or adjust your investment strategy based on current market conditions. For example, if rates are trending upward, you can reinvest maturing bonds into new issues with higher rates. The step-up interest structure of SSBs adds another layer of benefit to this strategy. Each rung of your ladder not only matures at different times, but also earns progressively higher interest over its lifetime. This creates a portfolio that provides both regular liquidity through maturing bonds and the potential for higher returns through longer-term holdings. Plus, with the government backing and no lock-in period, you maintain the flexibility to adjust your strategy if your financial needs change. Let's compare SSBs with other low-risk investments. Current fixed deposit rates from local banks range from 3.0% to 3.5% for 12-month tenures, but these require larger minimum sums and lock in your money. High-yield savings accounts might offer similar rates but often come with multiple conditions to meet. SSBs offer the perfect balance of flexibility and guaranteed returns. Looking ahead to 2024, economists expect the Federal Reserve to implement rate cuts. This could lead to lower SSB rates in the future, making the current offering more attractive. The Singapore government has also extended the 4% floor rate for selected CPF accounts until December 2024, showing their commitment to supporting citizens' savings. While Singapore savings bonds offer reliable returns and government backing, they work best as one piece of a well-rounded investment strategy. Think of them as a steady foundation rather than your entire financial house. For example, if you have $50,000 in savings, you might consider putting $20,000 in SSBs for stability, while exploring other options like stock index funds or REITs with the remainder to potentially earn higher returns. SSBs shine particularly bright for emergency funds or short-term savings goals, like saving for a wedding or home down payment within the next few years. They offer better interest rates than regular savings accounts, currently 2.48% for the first year versus typical bank rates of 0.05% to 1.5%, while still letting you withdraw your money whenever you need it. However, for long-term wealth building, you might want to consider a mix of investments. This could include higher risk, higher reward options like stock market investments for long-term growth, CPF special account top-ups for guaranteed interest, and perhaps some SSBs for that crucial stability and liquidity. The key is finding the right balance based on your financial goals, risk tolerance, and how soon you might need the money. If you found this video helpful in understanding Singapore savings bonds, please hit that like button and subscribe to the Investing Iguana for more Singapore-focused financial content. Next week, I'll be covering 5 ways to maximize your CPF returns in 2025. You won't want to miss it. See you in the next video.